you can
Well, welcome everybody to Fortuna Advisor Group's JobKeeper legislation past webinar. My name's Peter Westlund, and it's my pleasure to be your facilitator for today's webinar. We've got a tremendous response today. We've got over 150 participants registered for today's webinar. And I think that's a clear indication of how important this JobKeeper response to the economic impact of coronavirus is to both small and medium businesses in maintaining their workforces. Well, the much anticipated JobKeeper legislation passed through Parliament last night. And whilst there's no extension to cover casual employees with less than 12 months service, the laws remove a whole lot of uncertainty that has existed since it was announced about 2 weeks ago. Today, our expert panel expects to be able to answer many of your questions about the eligibility of your businesses and your employees for the JobKeeper payment. With us today are the Managing Director of Fortuna Advisors, Dinesh Aggarwal, and Stephen Gethin, the Director of Fortuna Legal.
Good afternoon.
I'll ask them a moment to introduce themselves. But let me just talk to you about the process. Many of you have submitted your questions about whether and how the JobKeeper payment applies to you, and we thank you for that. It has allowed Dinesh and Stephen to dig deeply into the legislation and the announcements and be able to provide their best interpretation of its application to your circumstances. However, not every situation is covered by the legislation or the announcements, and we expect that there will be further clarification in coming days. But we'll certainly do our best to answer as many questions as we can. So I'd like now to invite Dinesh to introduce himself, and then I'll introduce Stephen.
Thank you, Peter, and welcome everyone. Thanks for joining this webinar. Just a little bit of my introduction. My name is Dinesh Aggarwal, and the Managing Director of Fortuna Advisory Group. I'm a chartered accountant and a CPA with over 20 years of experience in Australian and international tax, business advisory, business planning, and strategy. Won few awards over the years as one of the top 3 SME tax advisors by Tax Institute in 2015, and the winner of CPA 40 Under 40 Young Business Leaders Award. Just a little bit about Fortuna. We are a multi-service accounting practice with main divisions in tax and business advisory, financial planning, legal services, and mortgage broking. And we try to develop comprehensive solutions for our clients and the businesses and the business owners for achieving the outcomes they desire. Fortuna has been highly acknowledged and awarded, being the Telstra finalist in the state, and also 2019 Multi-Service Firm of the Year by the Australian National Accounting Awards. Hand it over to Steve.
Thank you.
Thank you, Dinesh. Yes, I'm, as Peter said, a Director of Fortuna Legal. I have had over 20 years experience practicing the law in a range of environments, from large national firms to in-house counsel in various ASX-listed companies with Australian and international operations. Since 2013, I've been in private practice, boutique tax practice, and in 2016, I merged my practice into the Fortuna Advisory Group. So for the last 6 years or so, I've been working principally in the areas of taxation advisory law to small and medium business entities, and related areas of law such as self-managed superannuation funds and estate planning. So we are keen to unpack the details of the JobKeeper package for you. So Peter, was there anything else, or I will begin the speech now?
Yeah, I just wanted to make a mention of how we're tackling things today. Our program is first to invite Stephen and then Dinesh to provide you with a comprehensive overview of the JobKeeper program. Then we've got a whole host of questions that you've previously submitted to us, and we've got about 20 of those questions that we'll run through. Now, if at the end of those questions there's a particular question that you've not got an answer to, then we'll invite you to post that on the Q&A, and we'll see if we can deal with that in the time that we have available. So let's not waste any more time, and I'd like to ask Stephen Gethin to commence a overview of the JobKeeper program. Stephen.
Thank you, Peter. As people will be well aware, the JobKeeper laws were passed through Parliament yesterday. There were two main bills, and to give a summary title, there was the Omnibus Measures Number 2 Act and the Payments and Benefits Act. The Payments and Benefits Act is the one that you're probably most interested in. That's the one that provides the framework for the JobKeeper payment. The Payment and Benefits Act did, however, state that the eligibility criteria will mainly be set out in rules to be made by the Treasurer as soon as possible. Now, we haven't got the rules issued yet. Yesterday, there was a set of draft rules on the Treasury website. They were taken down, and we have managed to obtain a copy of them while they were still up. While the final rules may, of course, not be identical to the draft, we do expect that there will be a reasonable amount of consistency between the current draft, which would have been expected to be at a reasonably advanced stage, and what the Treasurer finally promulgates. So this seminar today is based on the Acts and those details which were not in the Acts, but which were stated to be part of the rules taken from that exposure draft. If when the final rules are promulgated, there is anything significantly different from what we tell you today, we will email up an update to participants. So the other bill, the Omnibus Number 2 bill, mainly makes amendments to the Fair Work Act to allow workplace flexibility related to coronavirus. So the entities that qualify for JobKeeper must have carried on a business in Australia on 1 March 2020 or been a non-profit body that pursued its objectives principally in Australia on that date. There's a range of excluded entities, including those who pay the major bank levy. Not too many of those in this virtual room, I suspect. Australian government agencies, local government agencies, an entity wholly owned by Australian or local government, a foreign entity that is an entity owned by a foreign government, or a company that's in liquidation, or a person who is bankrupt. Now I'll hand over to Dinesh to outline the declining turnover test which an entity must then satisfy in order to claim payments.
Thanks, Steve. So the decline in turnover test is the most important part of the legislation, because that determines your eligibility as a business to be able to claim the JobKeeper payment. So the test, as defined in the the rules which have been released last night, is that the entity must meet the decline in turnover test. The turnover reduction percentage is 50% if the entity's GST turnover exceeds 1 billion per annum, or 15% if it is an ACNC registered charity, excluding certain educational bodies. For all other employers, it is 30% reduction. The tax commissioner may also determine an alternative decline in the turnover test. Now, that would be, we'll be discussing that a little bit later. So the next question is, for what periods is the turnover compared? Now, the basic test, as per the basic test, an entity satisfies the decline in turnover test at a time which is defined as a test time if, number A, the entity's projected GST turnover for a turnover test period in which the test time occurs falls short of an entity's current GST turnover for a relevant comparison period, which is defined as a comparison turnover. And number B, the shortfall expressed as a percentage of the comparison turnover equals or exceeds the specified percentage for the entity. Now, this is a little bit more technical wording, but we will be explaining that more in a layman term in our question and answer session, just mainly to explain how it has been defined in the legislation. Now, the first month that can be used as the turnover test period is April 2020. And the last month that can be used is September 2020. The June and September 2020 quarters can also be used. To be eligible for a JobKeeper payment for a JobKeeper fortnight, the employer must meet the turnover test on a day in that particular fortnight, and any one day is sufficient. An employer meets the turnover test on a day if that day is in a month or a quarter for which the employer's projected GST turnover is 30% less than its actual GST turnover for the corresponding month or quarter 12 months earlier. So emphasis on the word projected. The required turnover reduction is 50% for a company with a turnover of more than 1 billion, or 15% for most ACNC registered charities. For simplicity, I'll just refer to the reduction as 30% unless addressing a specific question about charities. It does not matter whether the employer files their GST BAS on a monthly or a quarterly basis. It may choose either a monthly or a quarterly basis for their comparison. The earlier announcement stated that there'll be some tolerance where employers in good faith estimate a 30% or more or 50% or more fall in the turnover, but actually experience a slightly smaller fall. If the actual rules, when formally made, are same as the draft rules on this point, we do not agree with this, provided you make a reasonable estimate of your turnover during a month or a quarter. That is your projected turnover for the whole month or quarter, even if your turnover actually increases significantly at a later point during the month or quarter. I hand it over to Steve for further.
Thank you, Dinesh. We now come to the question of which employees are eligible. The employee, there's various conditions. The main ones are as follows. The employee must have been 16 years or above on the 1st of March 2020 and have been an employee or a long-term casual employee of the employer at that date. Casuals are excluded unless they are a long-term casual. And a long-term casual is defined as a casual who has been employed on a regular and systematic basis for 12 months as at the 1st of March 2020. Regular and systematic is an expression which is also used in the Fair Work Act. It does not require the employee's work to be as regular or as systematic as you might expect. So if the employee has done at least some days in each month in the past 12 months, they may well be regular and systematic, even if they're not working, the same 2 days every week, even if their hours or days do vary quite significantly. So even if they've had one or more months in the past 12 months where they've had no work, they may still be regarded as regular and systematic. There's a fair amount of case law on this under the Fair Work Act, because a casual who's regular and systematic has greater rights under Fair Work than an ordinary casual. So that question does get aired in Fair Work Commission and in the Federal Court on Appeal from the Fair Work Commission quite frequently. So we'll just be looking for guidance under the Fair Work Act as to what does that actually mean. So if you've got a casual who has not worked what the ordinary person would regard as reasonably regular hours consistently over the whole 12 months, you do have an open question about whether they are regular and systematic. So you should take legal advice on that. Whereas if they have worked sort of every Tuesday and Wednesday for the last 12 months, then you can be confident that they are regular and systematic, even if they've had the odd week off here and there because, they don't have entitlements to leave, but you gave them something in lieu of leave. That's regular and systematic, but once they start getting significant variations in their hours or significant periods where they did nothing, they may not be regular and systematic. So you probably need to get advice on that. The employee must be Australian citizen or a permanent resident or have a subclass 444 special category visa, and they're only applicable to certain New Zealand residents who are in Australia, New Zealand citizens who are in Australia. The employee must give the employer a notice in an approved form stating they meet the eligibility criteria. Those notices will no doubt be available from the ATO shortly, and no doubt your advisor, including ourselves, if requested, can provide you with that form. An employee cannot give a notice in relation to more than one employer. If the employee is on government parental leave pay or dad and partner pay, then the whole thing is based on fortnights. So people qualify in respect of particular fortnights. So if someone has received government paid parental leave for a fortnight or dad and partner pay, they can't claim JobKeeper for that fortnight. But then if they come off it during the 6 months for which JobKeeper is in effect, then they can go back onto JobKeeper, as long, of course, as you did employ them as at 1st of March. If a person is totally incapacitated for work and they are being paid under workers' compensation law in any given JobKeeper fortnight, they're not eligible for JobKeeper in that fortnight. But again, if they come off workers' comp during the 6-month period of JobKeeper, then they can claim JobKeeper for the remaining part of that 6-month period while they or the employer otherwise satisfy the eligibility criteria. The employer must satisfy the wage condition. That means that the sum of certain amounts paid to the employee every fortnight must equal or exceed $1,500. So to get to that $1,500, you can include salary, wages, commission, bonus, or allowances. And that's the $1,500 before tax. So from that $1,500, you'd normally be required to deduct some PAYG, pay it to the ATO, and that is also counted. So you're counting their before tax payments, not their after tax payments. And any superannuation contributions which you make for the employee's benefit are also included in that $1,500. So if you're getting JobKeeper for someone, even if their previous or current wage is less than $1,500 a fortnight, you have to pay them $1,500 a fortnight. If the employer usually pays employees for a period longer than a fortnight, and monthly pays are not uncommon, then you just need to allocate amounts out of that monthly pay to particular fortnights on a fair and reasonable basis. And the easiest way to do that would be just to work out what's their daily rate of pay, and then where a fortnight partly falls within a particular month for which you paid them. Just look at, well, how many days fell within that fortnight, what was their daily rate, and that's the amount that you paid them for those days. So it sounds a little bit complex, but it'll work out fine. If you're paying them a monthly pay which works out to more than $1,500 a fortnight, then there will be no issue. Now, this means people have often asked this because people want to keep their employees alive, so they've been often quite generously paying them, even though maybe they don't have the cash flow to really sustain that. Saying, okay, I've paid my, I'm going to pay my employee from a period beginning on or after 1 April, even though I haven't received JobKeeper yet. When I receive the JobKeeper, do I have to also pay that to the employee? No, you can keep that. If you've already paid them for that fortnight, then that's all the requirement is for you to get JobKeeper. You don't have to then hand the JobKeeper to the employee as well so that they get double paid. If you buy a business after 1 March, which has got employees, if those employees were employed by the seller at 1 March, then when the buyer takes over that business and takes over those employees, they're eligible employees for that buyer. Now, payments for working business owners, this is probably of a good deal of interest to people in this room, and there's been some controversy about this. Initially, it wasn't even that clear whether working directors or working trustees of a family trust who are individuals actually qualified at all, because the initial announcement said that the payment would be for employees or sole traders. The government did clarify in an announcement that they would then allow 1 director or 1 partner or 1 individual who's a trustee or 1 or to claim per business. Now, a good number of small businesses probably do only have 1 working owner in that category, but there are a significant number where there'd be 2 or even more directors working. Certainly a business partnership by definition has more than 2 working owners. So again, unfairly, this package, they have to pick one of them and only that one can claim. And it's too late to sort of put the other one onto wages now because they would have needed to have been on wages as at 1 March. Now, there's a couple of other requirements for working owners to claim. The entity must have had an ABN on 12 March. Note it's a different date to the normal start date, although the person must themselves have actually been a director or a partner at 1 March. An amount must be included in the employer's assessable income for the 18-19 income year in relation to it carrying on a business. And the Commissioner must have had notice on or before, the Commissioner of Taxation must have had notice on or before 12 March 2020 that the amount should be included in their income. So that would be by having filed an income tax return or for that year, even though they're not actually necessarily due yet, or a BAS. Now, as of 1st of March, the individual must have been actively engaged in the business. So those are the main requirements for working directors or partners, etc., for one of them to qualify. Now, the Omnibus Measures Number 2 bill made some very important changes to the Fair Work Act. There's been a lot of questions about, okay, so I had a full-time employee. Normally, you can't just reduce an employee's hours, or it's quite difficult, and there's a procedure to be followed. How do I just reduce their hours to pay them an amount that can just be covered by JobKeeper, because I can't, if they're not doing any work, my business is generating no revenue, I can't afford to pay them their formal wage. There are means of doing that under a pre-existing Fair Work, but they've been made a lot simpler by the Omnibus Measures Number 2 bill. So having said that, these measures are available only to an employer who qualifies for JobKeeper. It can make these changes to the working arrangements of an employee for whom it qualifies for JobKeeper. You can give that employee what's called a JobKeeper enabling stand down direction. And that doesn't need to completely stand them down, although it can. It can also reduce their hours or change their duties, and change their location of work, including to their home. If the employer has 2 or more locations, it could make them work at a different location to where they're used to working, as long as that's not unreasonably far for them to travel. In general terms, the direction must be reasonable. The employer must reasonably believe that the direction is necessary to ensure the continued employment of 1 or more employees. And it may not necessarily be the same as the employee that you're giving direction to. You might be giving direction to some employees to save cash so that you can save the jobs of other employees. Now, an employer and an employee may also reach an agreement about those matters. The agreements are somewhat limited, however, because the agreement actually cannot include a reduction of hours. So I'm not sure why anyone would wish to go down the agreement route when they can simply give a direction which is entitled to reduce the employee's hours. And I think in most cases, these will need to be used to reduce hours. Now, while an employee's hours may be reduced, the hourly rate of pay must stay the same. So to keep the math simple, if the hours of an employee who was formerly paid $1,000 before tax to work a 40-hour week are reduced to 20 hours per week, they must be paid $500 for that week. And of course, that would then have to be topped up. If they're on JobKeeper, that would then have to be topped up to $750. If they were on, say, $2,000 a week before tax to work a 40-hour week, and you reduce their hours to 20, then you would have to reduce their pay to $1,000 a week only, no more. So as you're maintaining their hourly rate of pay. Many employees are not strictly paid on an hourly basis, but simply paid an annual salary. In that case, you would just work out their hourly rate. It's not clear in the Act, but we think that the solution there is to just work out their hourly rate on a sensible basis. In other words, you divide their annual salary by 52 to give a weekly rate, and then divide that amount by 37.5, the standard number of weekly working hours, to give an hourly rate. If you do that, then there shouldn't be any issues. And the reason for the stand down, and this is going to be fairly easy to satisfy, it must be to do with COVID-19 or a government initiative in response to COVID-19. So to give an example of where this wouldn't apply, if you'd already made a decision to close a division and just happened to coincide with COVID, then you wouldn't be able to stand employees down on this basis. There are other alternatives under Fair Work that you could apply in that case, like you can just make them redundant. Those normal rules still apply. Now, a JobKeeper enabling stand-down direction does not apply to an employee during a period when they're taking paid or unpaid leave. And this question is, and we'll deal with this in answer to a specific question that's come through. You must also consult with your employee before giving them a direction. So just basically tell the employee what you're proposing, why you're proposing it, ask them for their input. You don't have to act in accordance with any objection that they might have. You just need to have given them a reasonable opportunity to comment. And, if they make a point that you can reasonably take into account, well, then it would make sense to do that. If you let an employee go at any time after the 1st of March, you can rehire them, and then they will be taken to have been employed since 1st of March. An employee, you can receive a payment for an employee, even if you rehire them, but you need to immediately stand them down to 0 hours. And that's the end of the summary of the 2 pieces of legislation. We'll now hand back to Peter, who will take us through a range of questions that have been fielded by participants.
Thank you very much, Stephen, and thank you, Dinesh. Clearly lots of trips and hurdles there to get through, is typical of tax and employment laws, but I'm sure that our questions, which are a very practical nature, will help us get through some of the tricky elements of all of that legislation. So our first question here is to Dinesh. Dinesh, how do I prove my business turnover is down?
Thanks, Peter. So an entity satisfies the decline in turnover test at a particular time, which is called a test time. And how that works is, if the entity's projected GST turnover, and that projected GST turnover is defined based on how you choose monthly or quarterly, which we'll discuss a little bit later. So if the entity's projected GST turnover for a turnover test period in which the test time occurs falls short of the entity's current GST turnover, for a relevant comparison period, which is called the comparison turnover, and we'll elaborate a little bit more down the track. The turnover means turnover for GST purposes and of the kind reported on your business activity statements. It includes the taxable supplies and all GST-free supplies, except with few minor exceptions, which will not be too much relevant for the ordinary businesses. But it does not include the input tax supplies, any export sales, which will be also addressed a little bit more specifically later, that what happens in case of the businesses who are predominantly doing export sales. So at this stage, just to recap, the turnover reported in the business activity statement, that includes the taxable supplies, the GST-free supplies, but not including the input tax supplies and export sale. If a business is part of a GST group, an income tax consolidated group, or an MEC group, that will be disregarded. Each company in the group required to qualify individually based on its own turnover, as it was not part of a relevant group. So some businesses in a tax or a GST consolidated group may be eligible for the JobKeeper payment, while the others may not.
Thank you, Dinesh. So clearly complicated, but in general terms, there's eligibility provided the GST turnover is dropped. We've got another question for you, Dinesh. How do I compare March 2020 to March 2019? Or if we're dealing with quarters, how do I deal with the March 2020 quarter to the March 2019 quarter? And then if we're looking forward to, say, April or May, how do we calculate that reduction in sales?
Sure, Peter. So the JobKeeper payment is payable in respect of JobKeeper fortnight. So they've sort of divided in the chunks of that you claim based on the so-called JobKeeper fortnights. The fortnight beginning on 30th of March 2020 is the first JobKeeper fortnight, as per the definition. And each subsequent fortnight until and including the fortnight that ends on 27th of September 2020 is called a JobKeeper fortnight. So all the fortnights starting from 30th of March to 27th of September 2020. To be eligible for a JobKeeper payment for a JobKeeper fortnight, the employer must meet the turnover test on a day in that particular fortnight, and any one day is sufficient. So an employer meets the turnover test on a day if that day is in a month or in a quarter for which the employer's projected GST turnover is 30% less than its actual GST turnover for the corresponding month or quarter 12 months earlier. So it's quite clear that the business can choose whether they're going to compare for a month or they're going to compare for a quarter. And there could be different pros and cons of whether you choose a month or a quarter, and we'll be elaborating that in one of the other questions later. But at this stage, you can choose whether you want to compare a month or a quarter. The required turnover reduction is 50% for a company with a turnover of more than 1 billion and sort of 15% for the ACNC registered charities. But at this stage, for most of the attendees in this room, probably most relevant is either 30%. There might be few charities or not-for-profits, and we'll address that if a not-for-profit is not a registered charity, whether they fall in 15% or 30%. But at this stage, for most of the small businesses, under $1 billion, reduction of 30%. It does not matter whether the employer files their it does not matter whether the employer files their GST BAS on a monthly or a quarterly basis when you are choosing a comparison period. It may choose either a monthly or a quarterly basis purely.
Dinesh, your sound is breaking up a little. You may
Dinesh,
wish to just move closer to the phone.
Yeah.
Is it better?
Yes, it seems to be.
So
just if you could repeat that last point, please, Dinesh.
Better.
About
Dinesh, thank you. Yep.
Yeah. So
yeah.
Yes. Okay. So what I was saying is that an employer meets the turnover test on a day if that day is in a month or a quarter for which the employer's projected GST turnover is 30% less than his actual GST turnover for the corresponding month or quarter 12 months earlier. It does not matter whether the employer files their GST BASes on a monthly or a quarterly basis. They have a full discretion to choose the turnover reduction for comparison purposes purely on a monthly or a quarterly basis.
So Dinesh, I just have another little question for you here, because one of our participants has asked, does it matter, and to what extent is it important whether you're reporting on a cash or accruals basis? Perhaps you could just touch on that.
Yeah. So at this stage, our understanding is that whatever your reporting system is in the BAS, where if you are on a cash or if you are on an accrual, that's what you will base your turnover reduction comparison for.
Okay, so consistent with what you've previously done. Look, Dinesh, I'm not going to let you off the hook just yet. I have another question. I have to register online. What happens if I don't register until late April?
So as we stated earlier, Peter, that JobKeeper payments are made in respect of each particular JobKeeper fortnight, as I elaborated earlier. So to receive a payment for a first 2 JobKeeper fortnights, which is the 4-week period ending on Sunday, the 26th of April, the employer must notify the commissioner before that date. So to claim for any later fortnight after that, if they did not register already before 26th of April, then the employer must have been registered before the end of the relevant fortnight to claim for that fortnight. Which means, except in the first 2 weeks, where you can backdate your registration by up to 28 days, you can only backdate your registration by up to 14 days going forward. That does not mean it is necessary to register each fortnight. Once registered, the scheme and the employer remains registered until it notifies the ATO that it no longer wishes to participate in the JobKeeper payment scheme. We do not know whether the registrations will operate on a weekend, although it should do so until further notice. However, we recommend that the people register on a weekday so that they can call ATO if there are any issues with their registration process.
So is there a particular format for registering, Dinesh?
At this stage has only been an expression of an interest.
Yes.
And we are expecting the registration applications to be live very soon, and we would know what particulars need to be entered for the registration process.
Okay, terrific. Thanks very much for that. We'll give you a rest for a moment and get Stephen on the case. So one of our participants has asked, can I terminate employees, bring them back as casual, and does that qualify even if their hours are reduced, Stephen?
Thank you, Peter. Yes, an employer may make an employee redundant, and as part of the redundancy consultation process, they could offer the employee an alternative role as a casual, were it not for the fact that that would make them ineligible for JobKeeper, because they wouldn't have been a casual for 12 months. As stated earlier, the only type of casual is a regular and systematic casual for 12 months. So don't do that, but there are other ways you can achieve exactly the same outcome. So you could, if you didn't even use those special provisions that were just put in place yesterday in the Omnibus Bill, even under the old Fair Work, and that still continues, you could make someone redundant, and then as part of redundancy consultation, offer them a new role as a part-timer, and then you'd have their hours reduced. But you probably don't need to go to that trouble. You could just give them one of these new JobKeeper enabling stand-down notices to say, well, and that's because it's not permanent. You know, the trouble with making someone redundant, then re-employing them as part-time, well, now they're a part-time employee, and, you know, once we get out of this corona problem, you've then got to go through the process of re-employing them as a full-timer. Whereas if you just give them a stand-down notice under this new provision, passed yesterday, it's just temporary, and you can even, you can even put a condition to say this applies until such and such, but may be revoked earlier if economic conditions improved or some such, so that you get them back into full-time work as soon as possible. So that's pretty much it. Just use the new procedure. We'll be preparing some draft stand-down notices and distributing them on our website so people can see what form a notice like that should take.
Thank you. Terrific. So I think we've got plenty of sole traders on the line listening to our webinar. What happens if I'm a sole trader and I've been taking my income as drawings and not as a PAYG employee? How does that tackle, Steve? How do we tackle that, Stephen?
Very critical question indeed for many in the business community. So people who are self-employed, and that's your, well, we're talking specifically about a sole trader here who doesn't operate through a company or a trust, they're eligible for the payment, provided that they estimate their turnover has or will fall by 30% in the way mentioned by Dinesh previously. They had an ABN on or before the 12th of March, not the 1st of March, although they do need to have been in business at the 1st of March. I'm not sure what the mismatch is about there. Now, they need to have either had an amount included in their assessable income for the 2018-19 year and included in their income tax return lodged on or before 12 March, or a later time allowed by the Commissioner. So Dinesh can correct me if I'm wrong here, but not necessarily every sole trader would have been even legally required to lodge their 2019 tax return before the 12th of March. So it would seem that if you were within time and you asked, when you hadn't filed it by the 12th of March and asked, you may well qualify for such later time as allowed by the Commissioner. Now, we would expect the Commissioner to act reasonably there.
You're right, Steve. I mean, most of the businesses would be falling on a 15th of May deadline to lodge their tax returns for 2019. So I suppose those who haven't lodged by 12th of March will have to rely on the criteria for their business activity statements if they have lodged from 1 July 2018 up to 31st of December 2018 by 12th of March. So if they're filing their BASs for that period regularly, then they should be eligible on that basis. That's correct.
That provides an alternative method of qualifying if you haven't yet filed your income tax return for the 2019 financial year. And the person needs to be actively engaged in the business. So if you just sit at home and it runs under management, then you don't qualify. So you need to be a working owner, and you need to satisfy the various other tests for employees, such as to principally the tests about citizenship, residence, etc.
Stephen, I've got a question about trust. Did you want to deal with that now or a bit later?
This is a question about a business operated through a trust. Yeah, let's take that now,
yes.
Peter.
Yeah, so Caroline's asked, what happens if I have a trust with one ABN but two branches for BAS reporting, and there are two separate businesses running with each business employing one person?
Yes, so if two different businesses are run and the entity conducting that business is a single entity, like in this case, a single trust has two different businesses that run in different operations, different places, they might even produce entirely different things and have entirely different employees, they're nevertheless treated as a single entity. So if the turnover of, say, only one of them has gone down by 30%, but the turnover of the other hasn't, you've still got to look at the total turnover of the trust as a whole. So if that hasn't gone down by 30%, they will not qualify for any of those employees, unfortunately.
Right. Okay. Look, going to another question for you, please, Stephen, if you don't mind. Can I reduce my employee's income on reduced hours to below the $1,500? And do I still get the $1,500?
No. So you need to pay them $1,500 minimum. You can pay them more if they were on more. You can use the $1,500 to top up their pay and pay them the rest of their pay out of your remaining cash flow, or you can reduce their pay down to $1,500. So, but as stated, to qualify for JobKeeper, they must be paid at least $1,500 before tax, and as I said, that can be made up of actual cash and it includes their superannuation contributions.
So just another supplementary question there. Can you pick and choose which eligible employees to use for JobKeeper, or do you have to put all the eligible employees on the program?
The first option, you don't actually need to claim it for an employee even if you're eligible. You'd hope that you would probably do so, but you know, maybe there's someone who wasn't really working out in the workforce and you may not. I mean, then you'd have an issue though, because if you didn't pay them anything, and you didn't give them, you know, they might be able to claim that they're being dismissed, even if you don't give them a formal dismissal notice. You really can't just stop paying employees. So you're going to have to, if you want to reduce the amount you're paying to this person, you're going to have to use a JobKeeper enabling stand down notice. And to use one of those, you're going to need to claim. So, you know, if they're a productive employee and your business is sort of making enough money to pay them their ordinary wage, you could theoretically not claim it, but you'd be silly not to. So yeah, the only circumstance I could think of where you'd want to is if you actually didn't want them around, but then you'd have to go through the dismissal process in any case.
Thank you, Stephen. Look, I'm going to move back to Dinesh now. What happens if I have two companies that are related and employ my people in one and myself in another? The company in which I employ myself, the business company, conducts the business. It pays the other company, the labour supply company, for the services of the employees. Dinesh.
Yes, so Peter, there's a lot of businesses like that who operate under that structure for various protection reasons. They use one main company that conducts all the sales, and the other company could be basically just doing all the staff, and there's a management fee charge between two entities. So the business, the company which runs the main business with all the sales will be able to apply the normal criteria for turnover reduction. So they just compare the sales, as we discussed earlier, with the comparison period, whether it's monthly or quarterly, and if they're eligible, they'll be able to claim. And if the owner is employed in that, he should be able to be claimed for himself, or can also qualify as one director, or if it's a trust, then it's one trustee or beneficiary. The labor supply company, which is the other company which is hiring all the staff, would normally charge a fee to the business for the services of the employees. And if it is charging more than $75,000 per year, then it'll be required to register the GST and have to stop the money which the business company pays to the labor supply company for the services of those employees. In that case, if the business company requires less labor and therefore varies their labor supply agreement for a reduced amount of management fee, and then that is used to prove their 30% reduction in their turnover for the service or the labor supply company, then that company should be able to also qualify for the JobKeeper.
Thank you very much, Dinesh. A question for you, Stephen, if I may. Is it right ethically that I keep the employees employed under the subsidy, but when the subsidy ends, I have to terminate them due to the market and business not having recovered?
Yes, Peter, I think it's completely ethical, because the purpose of the scheme, it's not to guarantee that anyone will have a full-time job once this corona crisis is back under control. It's to give everyone the best shot of still having their job at that time. So you're doing it genuinely to try to keep your employees employed. And if by some mischance things don't work out as well as you'd hoped, and you do have to lay them off at that time, then you've still tried to do the right thing. So I don't see any ethical qualms about that at all. And look, if things are still really bad in 6 months, we may expect an extension of the scheme is sort of a theoretical possibility. I mean, obviously there are limits to how much money the government can keep spending on this kind of thing, but and let's hope we're out of it by then. So I think it's a good opportunity, even if you don't end up being able to save every single employee. At least give it your best shot.
Yes, let's hope we are out of it by then. A question for you then, Dinesh. Obviously, businesses' turnover isn't stable all the time. I've got a question about turnover fluctuating substantially, and I haven't yet seen a downturn in activity, but I expect to finish completely at the end of April. When could I then apply for the subsidy? Is it quarterly or monthly?
So if the business owner does not think that his turnover for the month of April, for example, will pass the 30% reduction test compared to April 2019, but he expects that there are reasonable grounds that his turnover for the quarter ended 30th of June 2020 will be 30% below your turnover for the quarter ended 30th of June, you're still eligible. So you can then choose the quarterly comparison if you think in the first month of that quarter, your month-to-month comparison was not going to make you eligible. So that's where this flexibility of applying the discretion to use the month-to-month or a quarter-to-quarter comparison can help them to eliminate that sort of fluctuation aspect of their business. So if they, in that case, as I said, if quarterly basis in 30th of June, there is still a 30% reduction, they qualify. So you don't need to wait, and that's another important point. They don't need to wait till the end of the quarter to determine this. They can make a reasonable projection at any time during that quarter, because you then go on that fortnightly basis. You can register in any fortnight to claim that you will be eligible on a projected sales basis.
So just to clarify, Dinesh, you could even in the first week of, well, even now, you could project that my turnover is going to be less for the quarter and register now and start claiming in April, not wait until any later point.
Exactly, you can do that. And if you have the sufficient grounds to establish that your turnover is going to drop, you can register now. And later on, towards the end of the quarter, if you don't really meet the precise 30% reduction test, that doesn't necessarily means that you miss out because you've already started paying your staff during that period and started claiming the JobKeeper payments. And that's an issue for a lot of business owners who are under the perception that what happens, if towards the end of it they don't qualify. So you need to make a reasonable, or you need to make a projection or an assessment based on reasonable grounds as of today. And if towards the end, if you miss out slightly on that 30%, the commissioner can still accept that if you can substantiate your assessment at the beginning on reasonable grounds.
So reasonableness being the key question. So we've got a question here about somebody who's on an annual BAS, Dinesh. How would the ATO determine my drop in sales with an annual BAS statement?
Yeah, so now it's been clarified that the BAS filing period does not really matter because you can determine your projected GST turnover for April or for the quarter ended 30th of June. And if that projected is less 30% below for what the corresponding month or the quarter for 2019 would be, you will be eligible. So I mean, you won't have to wait for for an annual comparison because you don't have to file the BAS for 12 months. So based on the projected drop in the turnover, you would be able to register and qualify.
Excellent, good. Okay, and so of course we've probably got online a number of people who have only relatively recently and certainly within the last 12 months started their own business. And they're probably feeling the pinch. So if they've done that, if it's within the last 12 months and they've started the business and have now been affected, how does that impact them?
Sure. So yeah, we understand, of course, there's going to be a lot of startup businesses who have started within the last 12 months and have probably ramped up their operations quite fast in the first few months, and the COVID has really affected them. So if a business was not in operation a year earlier, or where their turnover a year earlier was not representative of their usual or an average turnover, for example, there was a large interim acquisition they did in that last 12 months, or they were newly established, or they were scaling up, and their turnover is highly variable. Now, the tax commissioner has the discretion in that case to consider the additional information that that business will have to provide to establish that they have been adversely affected by the impacts of coronavirus. The tax commissioner will also have the discretion to set out some alternative tests that would establish their eligibility in those specific circumstances. It is possible that the eligibility may be established as soon as a business ceases or significantly curtails its operations. So in that case, the commissioner will have a discretion to apply an alternative test.
Just to clarify some more on that last point, Dinesh, that actually appears to have been something that was previously announced, and we kept it in the script, but that seems to have been superseded by this our newer understanding based on the draft rules, in the sense that you just do it based on a projection. So if you had to totally permanently close your business today, then you can totally reasonably project that you're going to make no more income for the next month or the next quarter, or indeed any other period, and then claim. So you don't need to worry about appealing to the commissioner or special circumstances. So that one, fortunately, has been made improved by the release of the draft rules.
Yeah, you're right, Steve. I suppose in that last part of it, you probably will supersede. But then in case of the previous example where they have sort of made an interim acquisition or a startup and ramped up within 12 months, do you think it would still be based on the projected turnover and that they won't have to apply for commissioner's discretion?
Oh, look, certainly if you haven't been there for 12 months, you certainly do need to come up with an alternative basis to, you probably just go to the commissioner and say that your turnover is reduced. Again, I guess when you started up your business, your turnover is going to be quite low anyway. So you may be struggling to have met the 30% reduction test, and you'd then be trying to convince the commissioner, well, look, because I'm a startup, my turnover, I started 9 months ago, my turnover then was actually quite low. What you should really do is not take into account my low turnover from 9 months ago, but actually assume that I'd been going for a few years and my turnover would have potentially been a bit higher. That's probably the sort of argument that you would try to run. And yes, in those cases, you do need to rely on the commissioner's discretion. You can't just rely solely on making a projection.
I've just got a quick one here from Katie, and she's asked, just to clarify, once you've determined your reduction in income and become eligible for the payment, do you need to have to keep justifying that during the 6-month period, or does it last for 6 months?
You need to stay eligible. So if you got to a point where you're projected, somehow your business recovered within the period, so you got to a point where neither in the current month nor in the current quarter could you still say that your business was going to meet the 30% reduction test, then you would need to opt back out of the system. But if you've opted in once and your turnover continues to be progressively below the 30% threshold, then you don't need to do anything. You just stay in the system until it expires.
Thank you for that, Stephen. That's excellent. Okay, so a question for you then, Stephen. What if I acquired a business in the last 12 months which had existing staff?
Okay, so that's a nice, easy one. Thank you, whoever asked that. Yeah, simply, if they were eligible in the seller's business, then those employees are eligible in the buyer's business, as long, of course, as the buyer's business also meets the buyer's threshold reduction.
Thank you. Yeah, it is a good one. Look, many businesses, of course, are operating in partnership, and I think you mentioned that before, but not only partnerships, but also trusts and companies. What happens where there are a husband and wife working in the business full time, or they're unrelated partners or directors in the business? How would they divide the JobKeeper payment if only one is eligible to receive it?
Okay, yes, that's one of the points where, this has been a great package. We're very happy with it, but this is one of the points. We don't want to get too critical of the government, but we would like it if they had actually made that a little bit fairer, because if you take an example of some person, a casual or an employee who was on part-time hours, they may have only been earning, say, $300 or $400 a week, or even less, maybe a casual on $100 a week. My 16-year-old son is hoping his business will be shut down due to Corona because his pay will go up from $100 a week to $750. So, if those employees can claim, why has the government said that a second director in a business or a second partner can't claim anything? It doesn't seem entirely fair. And the good thing about them having put these in rules, not in an act of parliament, is it is easier to change them. So we should still, if you're in a business where you've got two working directors, or you're in a partnership, business partnership, both partners sort of work a reasonable amount in the business, you should be communicating with your local member of parliament saying, look, that's not really fair. We should both be able to claim. And hopefully, because it's in rules, it doesn't require the whole parliament to be reassembled in Canberra, the minister can just change it by the stroke of a pen. Hopefully, we will be able to get that one changed. So to answer the question specifically, I guess if it's a husband and wife, both working business owners, well, yeah, I mean, they sort of pool it, generally, they often enough pool their income anyway. Even if they're unrelated, though, it still doesn't make any difference. And this is where it's probably even more unfair. I mean, I guess they could agree between themselves to split it. One of them would have to nominate to claim it, and they could have a sort of an agreement to pass half of it to the other. I mean, we'd have to think about whether there were tax implications of that, because it might end up being taxable income of the second partner, I suppose. So there's a few issues around that. It is a little bit unfortunate. The only possible exemption, the announcement did say that, but only one director would be able to claim per business. But looking at the draft rules, we're still working on this, don't quote us on this, but it looks like there may be a possibility that one director could claim if they were paid wages, directors' fees at 1 March and continue to be paid directors' fees, or even if two directors were paid directors' fees at 1 March, they are not necessarily excluded from the definition of employees. They may be able to claim as such. So we just need to work through that one, watch this space. But if one of them was employed on wages and one was just working and taking dividends, they might actually be able to claim one claim by way of being a business owner claiming dividends, and the other one claim as an employee. But it's a bit grey at this stage, so we do need to clarify that for participants, which we'll do ASAP after this seminar.
Yep. Okay. So there's another one on unit trusts. What happens in the case of unit trusts with 100% units owned by the family trust?
Yeah, that's a fairly common business structure. And so the question gets at one of the definitions of a working business owner who can claim is a beneficiary. If the business is conducted by a trust, a beneficiary of the trust who works in the business can claim as an employee, but only one. So often enough, there are quite a few beneficiaries in a trust, often enough a husband and wife or domestic partners. They might both work in the business, only one of them can claim. But where the unit trust doesn't distribute directly to any beneficiaries, but distributes to the trustee of a family trust, who then distributes to beneficiaries, at the moment, those beneficiaries at the end of the chain are potentially not beneficiaries of the main trust which conducts the business. Therefore, they potentially are not eligible to claim as beneficiaries. I mean, if they're also directors, they may be able to claim on that basis, which is common enough. But if it's a unit trust that's run by individuals, not a company, then they would appear to be excluded at this stage. Again, that's something where we will be making a submission to the government to see if it can fix that one up.
Right. There's a supplementary question sort of related to that one too. What happens if a company has not paid dividends or a trust has not distributed profits due to losses in the past then, Stephen?
Okay, we've got a better answer for listeners on that one. It doesn't matter. So we thought it might matter because an announcement said if they were paid by way of distributions or dividends. Well, the question did fairly arise, what if it hasn't been in profit? In the draft rules, it doesn't refer to how they're paid. It just says if they are a director, a beneficiary, a shareholder, or a partner, they can claim one per business. So they won't need to have ever made a profit.
And
Okay,
that would
that's good.
probably apply, Steve, even if sole traders had made a loss, it should not matter because it's based on the turnover reduction and doesn't matter
Exactly.
profit or loss.
Okay, we'll give you a bit of a rest then, Stephen. The not-for-profits and charities now, so I imagine we've got a few of those on the line. The sales drops required is only 15%, but a lot of these don't have a set pattern of sales, as they could be getting one-off grants and then no income for a few months. How do you calculate and compare their sales drop?
Yeah, so where the turnover of a business or a not-for-profit is typically highly variable, the tax commissioner will have the discretion to consider additional information. Now, whether the organization can provide that sort of substantiation to establish that they have been adversely affected by the impacts of the coronavirus. The commissioner, I suppose the alternative test, Steve, you already mentioned, is not going to be any more applicable. So it's going to be purely if they don't fall under the normal turnover criteria, where it's a similar situation of fluctuations because they get one-off grants and they might not have any income for next 2-3 months as they're utilizing that grant, and then they get another one-off grant or sponsorships. So it pretty much falls in a similar criteria where they have to apply to the commissioner that the normal rules don't apply to them in determining their sales reduction, and the commissioner will have discretion to look into their circumstances and approve their eligibility.
Right. Okay. Thanks for that. Back to you then, Stephen. What happens in a company which has multiple divisions or branches with different activities? However, one division is affected with more than a 30% drop in turnover, but the other is still doing quite well, so that the combined sales have not fallen by 30%.
Yes, unfortunately, in that case, the business won't be eligible. The only way it would be eligible is if they actually ran the different divisions through actual separate companies or separate trusts. Then you could look at each individual one and claim at least for those which had fallen below. But one business through one company or through one trust with many divisions, some divisions fall short, not all, but as an average, they don't fall short. Then no claims, unfortunately. Right. I mean, you might look at those that was legitimately responsible. You may look at closing a division, or I suppose will help you have to close more profitable division, which will make any sense. No. So yeah, little you can do. That's probably a good point. Obviously, imagine penalties for anyone who gets into any artificial conduct. But trying to attract bonus or anything else that say legitimate business reaction to corona, don't do anything else to try and get the payment, because it will actually end up getting taken off.
Has the law clarified to reduce the hours of full-time employees and not have to go through the redundancy process under the Fair Work Act, so that I can support staff reduced hours under JobKeeper payments? Yes,
so as mentioned, you can actually give them a JobKeeper enabling stand-down notice. So I won't really yes, you can have hours as long as you can pay the sums of
One Dinesh, I just recently excluded from the GST. So how will the business determine their drop in the house at key metrics of this situation? You're breaking up.
So only onshore GST free sales, only limit flights which are not likely to rise very commonly in business are excluded. We are, however, still reviewing whether exports are excluded, and we will provide an update on that with notes that we'll send out after the presentation.
Look, we've the hairy aspect of casuals, 12 months casuals, is being raised in this next question. What's the definition of a 12-month casual? So, Paul, they said if someone worked, say, 5 hours 11 months ago, and you've not terminated them, are they a 12-month and need to have worked in the period to qualify?
Okay, yes, interesting question. So no, that person who's worked 5 hours 11 months ago would not. I'm actually not aware of the answer to that. I know we know it within the group, and we will take that one on notice and email out. I believe the answer is no, but you can't.
Will be backdated to Monday of March. Used up their annual leave within the period from Monday the 30th of March 2020 onwards. Now, I guess there's a number of employers have done that just to sort of consume annual leave that may be quite significant.
Yes, I mean, as a technical legal matter, there's no problem at all with the employer and the employee agreeing to reverse that leave and treat it as salary, treat them as being stood down with no duties but being on paid leave. And then treat that as the $1,500, whatever was paid to them, as satisfying the requirement that they get at least $1,500 to claim JobKeeper. So, I mean, whether the ATO is likely to consider that an artificial scheme, I think it's very unlikely given it's just a goodwill thing that the employer did and they're just saving themselves from unreasonable cost. I think that should be fine. So that can be reversed. That the employees will not have wasted their leave.
Right. Okay, thanks for that. Does an employee who has been stood down recently need to recommence working to be eligible for JobKeeper?
Yes and no. They do need to recommence being having an employment relationship, but they don't actually need to do any duties. They can be put back on the payroll, have their employment contract re-signed, and then immediately stood down to 0 duties. As long as they're paid that $1,500, then they're eligible.
Oh, terrific. So that's a good outcome. One for you, Dinesh, if you're okay, you can hear us again. Keen to know how JobKeeper payments will work for not-for-profits, specifically those who aren't registered with ACNC, and of course there are a lot of those. Can not-for-profits still claim at all with the new criteria for not-for-profits announced last weekend?
Unfortunately, at this point, the not-for-profits that are not registered as charities, they will not fall under the 15% reduction category. So they will have to then be treated as normal business entities, and they will have to qualify for the 30% reduction test. Unfortunately, unless we get any further clarification on that. But at this point, if they're not registered charities, the not-for-profits will be treated as normal business entities to qualify for 30% reduction.
So I guess that affects a lot of sporting organisations who aren't necessarily registered as with ACNC then.
It will be a lot of, it could be a lot of business associations, sporting clubs, organisations like that. They could be impacted if they don't fall under 15% criteria.
Right. So that's at the end of our questions that have come in before the session. I've just been flicking through some of the questions, the other questions that have been coming in whilst we've been on the line. Here's a peculiar one. Are donations and private grants included in BAS total sales? Also, what factor generally would be taken into account when accessing the 30% decline? Is it total sales or GST collected?
Steve, you going to take that, or you want?
Oh, sorry, Dinesh, did you wish to take that one?
Yeah, that's fine. At this stage, I mean, I suppose the question is is the normal donations and private grants included in the BAS total sales? So just looking at what factor generally taken into account when accessing the 30% is the labor total sales or GST collected. If I understand the question correctly, it says that if this is probably mainly applicable to the not-for-profit, that their normal sales reported in the BAS would be the donations and the private grants, which I don't think the donations are subject to GST, so they probably would appear in the GST-free sales, and the private grants might be subject to the GST. So yes, they will just, the normal criteria of 30% or 50%, whichever is the case, applicable would apply to the sales which are excluding GST. You can report sales including GST in the BAS, but the reduction criteria would apply to your sales excluding GST, because that's what sort of goes in your net income in the profit and loss account.
Thank you there, Dinesh. I've got one here from Linda for you, Stephen, I think. If I have a person being paid as contract on a regular basis with a weekly payment, but no PAYG, are they eligible under JobKeeper?
Yes, very good question. A very common arrangement to have some of your personnel on. So they're not able to claim themselves. We'll call them the employer, but the company which contracts with that contractor can't claim JobKeeper for that contractor, because unless they're an employee under Fair Work, because that's where the definition of employee for this purpose comes from. So Fair Work is actually quite jealous to prevent employers from putting people who are really employees, just treating them as contractors. So that's the first question to ask. If they work like an employee, they're not responsible to bring a lot of their own equipment and they don't get much control over how they do the job, even if you call them a contractor, they'll actually be an employee for Fair Work purposes. If, however, they're a genuine independent contractor, which Fair Work would accept as such. So, for example, if they've got a certain amount of discretion about how and when they do the work, and they bring to the job a significant amount of valuable tools or capital, then they're a genuine contractor. That employer can't claim for them, but they then are likely to be conducting a business themselves as a sole trader, and then they can go off and claim directly themselves.
Right. Look, I've just another one. May's asked a couple of questions, so I'll combine them together. If the employees are on permanent part-time position from the last 4 months, are they eligible for JobKeeper payments? And the supplementary one then is, are provisional resident employees eligible?
Permanent, a part-timer, yes, because if they're not a casual, if they're on a proper part-time employment contract for only 4 months, that's fine because they will have been there since before 1 March. And the second question, sorry, if you could just repeat the second part, please.
Yes, provisional resident, are provisional residents covered?
Yeah,
it's quite eligible.
It's quite tough on people who don't have very, very solid immigration status. So you either need to be an Australian citizen, an Australian permanent resident, or you need to be a Kiwi on a 444 visa. So anyone else who, any of the people who are here on 457 or the 482 replacement visa for that, they do not qualify, unfortunately.
Right. Jason's asked, and I think I'll put this one to Dinesh, you've mentioned reasonable projections based on reasonable grounds in reference to predicted downturn in income in a fortnight. Are you able to give us an example of what might constitute reasonable grounds? If billing in first week of April is down 30% or greater than 30% in 2020 compared to 2019, would this be considered reasonable? So I think it's the reference is to that week.
Yes, so I think if not because of COVID, you will assess that any other reasons could have led to a drop of 30% in the first week of that month in your sales, then that means COVID is not the reason for your drop in the sales. But if you see that just in the first week, because of the COVID, you had straight 30% or more reduction in your sales, I think that can become the basis of your reasonable projection to say that you might have a similar trend of drop above 30% for the rest of the month or for the quarter.
So on another question, and this is from Adele, Dinesh, does the PAYG withholding from JobKeeper flow to the boosting cash payments and additional payments? So I guess you're getting a bit of a double up there.
Yes, but yeah, it's not, well, I mean, the double up, it's not necessarily that just under the JobKeeper that you have a PAYG to be withheld on those JobKeeper payments and the double up will happen. It could have been just normally the boost, the first boost or the cash boost started applying on the PAYG of the wages reported in the BAS, and then the JobKeeper came in which it has been said that the JobKeeper payment would still be classified as the normal wage payment to the employee, is assessed in a normal way, and the tax has to be withheld. So yes, the PAYG on those wages, because they have been treated as a normal wage and will be reported in the BAS, would become part of your normal cash boost under the previous stimulus package, which is between $20,000 to $100,000.
One for you, Stephen. Will the ATO be able to confirm eligibility based on OTP records for regular and systematic employment before I commit to making the payments?
You can normally, but if it's a matter of tax law, you can get a ruling on any circumstance like that if you're not sure about it. The trouble with that is the tax office is going to be very overworked. It could take a significant time to get a ruling, and we're actually not sure whether this falls within something the tax office would give a ruling on. It's a good point. We'll check it, but normally you're going to have to make your own judgment on that. I think if you want a decision at any reasonable time so that you can actually pay that person in any meaningful period.
So actually another question there from Martin. He's still a little confused. Can he choose any month or either quarter between April to September as my test time?
Well, it's got to be a quarter. So the fortnight for which you're claiming has got to be in the relevant month. Of course, so you can't like project, okay, I'm claiming now because I project my May turnover will be lower. But you can claim now because you believe your April turnover will be lower, or the quarter in which April falls will be lower. Once we get past June, then obviously you can use the current month in June or the whole June to September quarter.
So Ms. Barr's just asked, just wanted to know the next step. What step, once you've registered interest in the scheme, do you get a notification from ATO at this point? You mentioned about registering afterwards. Yep. So I just want a little bit more explanation around that process there.
So the expression of interest which opened up on the ATO, that is sending automated acknowledgement as soon as you register your expression of interest, so that gets acknowledged. And when the formal registration opens, then I'm pretty sure would be a similar process. Once you submit your registration, there will be an acknowledgement. We don't know at this stage whether the accountants or the tax agents can do that registration on behalf of the clients, or whether that can be done through the portal system, or whether that would be just a normal online application form similar to the expression of interest, which is just directly on the ATO website, rather than having a normal sort of through a lodgement portal or a lodgement process.
One for you now, Stephen, I think. What about super? You've said that super contributions can come out of the JobKeeper payment rather than us paying that 9.5% on top of that out of our company earnings. However, how do I do that in my MyOb system to make sure that it comes out of that $1,500 and not added on top?
I might actually pass that one over to Dinesh on the basis that he is an expert on accounting system packages.
Good one.
Yeah, it's going to be a little bit tricky, and I would expect the software systems to adopt this anomaly that you have a discretion not to pay the super on the top-up amount if your JobKeeper payment is more than the actual wage you are paying. So as you process the wage through your software system, it will calculate 9.5% and SGC. And if you decide not to pay on the top-up amount, you will have to manually exclude that. We expect that the software company should adopt that feature pretty quickly to make it simple. Otherwise, doing a manual adjustment could be quite cumbersome.
Martin asks, in fact, he tells us a little bit about what's happened in his business. I had a strong Q3 for which most payments will be made in Q4. So even though my current business is down 75%, so that seems pretty significant, and I have had to stand down 7 casuals, I can't risk paying them JobKeeper as my reportable cash flow may not be down 30% for any month this quarter or for the quarter as a whole. Can you see a way to deal with that?
Steve?
That's one. So it depends on whether he's filing on an accrual or a cash basis potentially, would it not, Dinesh? Sent out a lot of invoices in Q3, which is just finished. And he's going to get paid that money in Q4. If he's filing on an accruals basis, then potentially he won't accrue that much in Q4. Whereas if he's filing on a cash basis, he may accrue more, being those payments coming in from invoices sent in Q3. So what's the potential, Dinesh, to change? I mean, obviously, if you just change to try and qualify for JobKeeper, it might be seen to be a scheme. So.
Yeah, Martin's just come back and said he's on a cash basis.
Okay, Dinesh, do you want to take it from there?
So if he's on a cash basis and and that's what we think that if your BAS is being reported on a cash basis or an accrual basis, that's the system you will use to determine your drop in the sales. Now, because there's two sides to the story. Because if, let's say, if they would have determined your system to be used for drop, let's say they say as per this bill that only you can use the accrual system, and there's an argument that if my sales sort of might drop based on an accrual basis, but not on a cash basis when I'm doing an actual comparison because I recovered more debtors in a particular period. And those those people could have been affected in that category. And on the flip side, someone who is on a cash basis might have a larger drop because their debtors didn't pay them during that period versus what they billed during that period. So, I mean, at this stage, if you are on a cash basis for your BAS reporting or an accrual, that's what the method you will have to use to determine your sales for that particular period. Now, it is going to be a little bit tricky. Let's say if you're on a cash basis and you're making a projection of your sales that my sales is going to drop 30%. And whenever you're making a projection, you generally base that on how much billing you are going to do or how much work you're going to get done and bill during that period. But if you are now have to compare on a cash basis because your reporting mechanism was on a cash basis, that means you need to do a projection that your cash sales will drop by how much. I mean, the only comment I can make on this stage is that if you're expecting your sales to drop by 30%, you will say, okay, well, I mean, of course, you're not going to collect money because you not made any sales. So I suppose on a cash basis, you will qualify as well. If your accrual sales drops, your cash sales will drop as well. But I mean, if you just expecting your cash sales to drop because some of the people won't pay you during this period, I suppose you can use that as a criteria for your projected sale reduction, but it's going to be a little bit tricky just because how do you make a reasonable assessment on that? I don't know, Steve, if you have any comment on it, that how would you make a reasonable assessment if you say my projected cash sale is going to be less because I'm thinking none of my customers I'm going to bill are going to pay?
I would agree. That would certainly be a potential basis on which you could actually have a reduction in cash sales for that quarter. You would probably need to start keeping a very close comparison on the speed at which your debtors have been paying in the quarter starting today, or starting on the 1st of April, compared to what they probably would have, the speed at which they would have normally paid in say, the corresponding quarter last year. And if it looks like that's slowing down significantly, and maybe even if you've got one or two big clients and you actually know that they're in serious difficulty and they're not going to be able to pay, that could be a basis for projecting that your cash turnover is going to fall below the 30%. So there could be a couple of different strategies there to look at. Another thing, though, just assuming that you can't confidently predict that for the next quarter on a cash basis, you will get the turnover fall. There are other strategies you could possibly use to try to keep your employees around. And that would be, because you wouldn't be able to use the JobKeeper stand down notice because you're not confident they're going to get JobKeeper. But you could use an alternative strategy that still remains under Fair Work. For example, you can actually give employees a general Fair Work stand down under a pre-existing section, which doesn't require them to get a JobKeeper payment, Section 524, and where they've got no work to do for no fault of the employer, and you can stand them down on no pay. You know, you can do strategies like get them to use up some of their leave, although again, that could have cash flow implications. They may just try to take their leave anyway, and there's not much you can possibly necessarily do about that. But yeah, so that or make them redundant and put them on, and just tell them, look, as soon as you're able, you'll try and get JobKeeper, and as soon as you're able to, you'll claim it for them. Obviously, that runs a risk of them not being there when you're able to claim JobKeeper, but at least it doesn't mean that you've got absolutely no HR type options in relation to them.
Steve, one comment, I don't know if there's any commentary you saw lately in the bill, whether because the projected sales doesn't necessarily mean need to be reported through a BAS system because your BAS is going to be due to be filed a little bit later down the track. So once you have registered, how would the projected sales be reported to the ATO?
That's something that they're going to probably try and check that with hindsight. So you don't tell the ATO what, as far as I understand the process. I mean, it does say that you've got to nominate on a form specified by ATO, so ATO might require what your projection is. But even if they don't, what they would possibly start doing is at the end of the period, if it looked like from your actuals that you didn't qualify, they might say, okay, well, your projection was wrong. And then if it's not that far out, they might just leave you alone. If it's significantly far out, they might raise a query, but then it would still be open to you to show that, well, actually the projection was reasonable at the time and that met the test of the legislation. Therefore, I still actually do qualify.
Yeah, so unless they release a particular form which you can fill in and file with them on a regular basis, you might have to, or the businesses might have to make some minutes and keep it in record based on a reasonable assessment they will do on a particular point of time. So that
always have a very well documented basis for taking a position like that.
So, sorry, Peter, I dropped out earlier for a couple of minutes. There was one very good question raised about the use of the annual leave. Was that already addressed, Steve?
Yes.
Okay.
Yes, that was, yes. Yep. Okay, so I've got one question from Adam. If I don't see a downturn in sales until June, is JobKeeper back paid to March or just the month of the claim?
No, there's no JobKeeper, it appears, for the month of March. It's only for April.
Right, okay. And another for Jeremy, and he says, I anticipate that one of our trusts will have a decline in turnover well in excess 30% for the next 6 months. Are family members eligible employees for the purpose of the JobKeeper program, where they receive all of their wages, in inverted commas, by way of salary sacrifice in superannuation as an annual lump sum? They also receive a distribution of ordinary income through the trust elections each year.
Yes, if they're paid superannuation in lieu of wages and they salary sacrifice it all, then they ought to be able to claim as employees. But because they're also beneficiaries, we would just like to take that one on notice, just to make sure that we haven't had time to go through this in fine-tooth detail, as you can imagine, just to make sure the fact that they're beneficiaries doesn't actually disqualify them from also claiming as employees, even where they are actual employees.
So just, I might add a comment there, Steve, that if they are the employees in the business and they are 100% salary sacrificing to the super, because that would be reported as reportable super contributions, and you have to issue a payment summary, that kind of makes you qualified as an eligible employee because they are in the payroll system, or they are considered as an employee because the salary sacrifice has to be reported as a reportable super contribution. So I would think they would be treated as normal under the employee category and will qualify on that basis. They wouldn't have to go under the owner trust beneficiary category.
You would hope the fact that they're employees means that they can actually just be paid JobKeeper on that basis, and that the fact that they're also beneficiaries does not disqualify them. But there is a small possibility that being a beneficiary would disqualify them. So we will check that one and and provide an answer by email.
So there's been lots of questions come in online, and unfortunately the time doesn't permit us to cover them all, but certainly what we will do is provide you with some responses where we haven't responded to your specific question during the webinar. But I thought I just might give each of our panelists a final comment before we wrap it up, and starting with you, Dinesh.
Yes, so I would say that a lot of ambiguities which we had before last night, the bill went to the Parliament and the exposure draft was released. I would say 80 to 90% of those ambiguities have been answered, as most of our attendees would have seen that we've tried to cover as many questions we could see from our clients and from general business owners who have sent us the questions in the last 24 hours. I'm pretty sure there's quite a few still questions, but which might already have an answer, and we'll try to put a fact sheet together. And please stay tuned to our resources on our website, and we are releasing a lot of information, and we would probably try to cover and answer all these questions in an FAQ as well. If there are any unanswered questions, just because there's not a clarity from the Treasury yet, we hope that we should get some more clarification as the final exposure draft gets released. There are still going to be a few issues which are going to remain in the law as this becomes the law, and the topmost on that is for multiple directors or partners in that kind of a structure in a business, which can only then now move if there's an amendment to the rules by the treasurer. So, but I would just say that please stay tuned to all the communication being released from Fortuna, and you'll probably be getting the information on a live basis as we go.
Stephen, did you have some final comments?
Yes, thank you, Peter. Yes, it's a reasonably good package. There are a lot of questions, but we think the answers to them are now emerging, and the answers to most of them are fairly reasonable that people are going to be able to work with, except for one or two issues which we've identified. We'll be rolling out comprehensive resources on our web pages to deal with all these questions and updating them as anything changes. So please stay tuned. Happy to help out if there's any specific sort of more complex implementation around HR or anything. As I said, we'll be posting some draft notices that people can use to do stand downs, etc., on the website early or over the Easter break. So let's all keep well, keep optimistic, and we'll all be back out stronger for the experience in not too many more weeks, we all hope. Thank you all for participating.
Thank you, Stephen. Thank you to the panelists, Steve Gethin and Dinesh Aggarwal. We've run you through the hoops with all of the questions. Thank you very much to the audience for all of the questions that you've asked. I'm sorry that we haven't been able to answer all of them, but as I said, we will follow them up. It's been very insightful, and we've enjoyed your company today. Have a happy Easter, albeit confined to barracks, and look forward to perhaps being able to present you with another webinar in a week or so's time where we can pick up some particular issues and deal with those. All the best.
Thank you so much, Peter. Thank you, and thank you all.
Thank you.
For the rest, and have a good Easter.